You are watching Macro TV. We are busy with Study Unit 2, the basic model of the macroeconomy, and this is from Chapter 3 in Fourie and Burger. This video is number 9 out of 10 videos covering the content of Chapter 3. We're looking at the IS LM model as a way to explain macroeconomic changes, policy changes or shocks in the economy, and to see what the impact is on interest rates and income. Now, we've already talked through the derivation of the IS curve and the LM curve, and now we can discuss changes in the economy and how that would be modeled using this. Now, if we use them together, we can say, for example, start at point number 1. You'll see it's over there with an interest rate R1 and a level of income Y1. Now, at this point, you do have equilibrium in the real sector because point 1 is along the IS curve. But it's not an equilibrium in the monetary sector because point 1 is not on the LM curve as well. So at this interest rate R1, the demand for money is lower than the supply of money. It's a relatively high interest rate, which means that people would rather put their money into financial assets than to keep it in cash. And that's typically what happens. The higher interest rates discourages the people's need to hold money. They buy financial instruments, causing the price of these instruments to increase and the interest rate to decrease. So interest rates decrease along the LM curve, and at the same time, these lower interest rates causes investment to increase and output to increase, and there's a movement along the IS curve to an equilibrium point at point 0, where you see the interest rate is now at R0 and the equilibrium income level is at Y0, and there both the real sector and the monetary sector is in equilibrium at the same time. Now, it's possible to also argue this story from point 2, and you can start there with point 2 on the LM curve and say, yes, we know that this is an equilibrium in the monetary sector, but not in the real sector. The interest rate R2 is too high for a goods market equilibrium, so investment and consumption will be relatively low. If that happens, it means that inventories will start to pile up, production will be cut back, and at the same time, income gets lowered. Now, when that happens, the demand for money also decreases. That means that interest rates come down, and there's a movement along the LM curve back to equilibrium. Movements of either the whole IS curve or the whole LM curve, you are already familiar with what drives such a change. The IS curve will shift if there's a change in exogenous expenditure. So it could be an exogenous increase in consumption or investment or government spending or exports or imports. The LM curve will shift if there's a change in the price level, because remember, on the monetary side, we're looking at the real demand for money and the real supply of money. That's where we're dividing by the price level. It could also shift if there's an exogenous change in the real demand for money or the supply of money, typically as the Reserve Bank would influence the supply of money in monetary policy. Now we'll look at 2 examples next. First, we can look at the case of expansionary fiscal policy. Government spending increases. And what happens in our IS LM model? Now, the primary effect of an increase in government spending is that the IS curve moves to the right. You can see over here, you start with an equilibrium at Y0 and R0. There's an increase in government spending labeled there as number 1, and it pushes the IS curve to the right. And there's, of course, a huge increase in output, and everybody says fiscal policy is very successful at stimulating the economy. So that's not the end of the story. There's a second round or secondary effect. Because of this increase in incomes that we now see happening due to the expansionary fiscal policy, we also have an increase in the demand for money. We know that there's a positive relationship between the demand for money and incomes. That increase in the demand for money causes an increase in interest rates, which then causes a reduction in investment, and then total expenditure decreases. And that's the movement that we see from point 1 to point 2. Back along the IS curve, where investment is a little bit less and total expenditure is a little bit less, and there's a reduction in the output to the level of Y1. So that's the final equilibrium, where you again have equilibrium in both the real and the monetary sectors, and it's at a higher interest rate and also a higher level of income. So in that sense, the net effect of the expansionary fiscal policy is stimulating, but it's not as big as you initially would have thought, and it's accompanied by an increase in interest rates. The second example is of expansionary monetary policy. That's if the Reserve Bank decides to stimulate the economy. That would typically happen through the lowering of the repo rate. Now, in our IS LM model, you describe an expansionary monetary policy by a rightward shift of the LM curve. You can see the LM curve moving towards the right. And that means that interest rates are lower and incomes are higher. Typically, as interest rates decrease, investment increase, total spending increase, and output increases. But there's again a secondary effect. Once incomes start going up, the demand for money increases, and it causes interest rate to increase, which discourages investment and decreases the total expenditure. You can again see that initial primary effect movement from the equilibrium 2.1, and then the secondary effect from 1 through to 2, which puts you at the new equilibrium level. So again, the expansionary monetary policy does have a positive effect on output. Output increases and interest rates do decrease, but not by as much as that initial decrease. The second round effect causes a slight increase in interest rates again. Now, this video showed how we can use the IS and the LM together. And these examples of expansionary fiscal policy and expansionary monetary policy are important ones. And you can see the IS LM gives us a nice tool to think through what happens in the macroeconomy when policies change.